Most videos on YouTube do a great job of answering the question, when should I start investing? And the typical answers are start ASAP, start investing early, have a long-term view, start with SIPs and so on. But one question that doesn't get addressed enough is, when is the right time to exit an investment? It's a question that comes up often, especially when there is a correction in the market or when the markets have really shot up. So in this video, we look at 4 specific scenarios when one can explore exiting their investments, and more importantly, how can one go about developing an exit plan. Let me start with a true story. The story dates back to 1929 when Joe Kennedy, the father of the US President John F. Kennedy, was running his investment firm in Wall Street. One day, when Kennedy Sr. was getting his shoes shined, the boy shining his shoes started to give him stock tips. It was at that moment Kennedy realized that the bull market in the United States had reached levels of irrational hysteria, and once he got back to the office, Kennedy started the process of pulling out of the stock markets. And by the time the 1929 crash and the Great Depression came along, he had liquidated most of his positions and was probably one of the few winners of that period. I tell you this story as it illustrates the importance of recognizing high levels of hype evident from people jumping recklessly into the stock markets and investing in instruments that they really don't understand. The signs of such market euphoria are everywhere, especially if one starts looking for it. For instance, when you see more growth stories than proof of earnings, when we see companies or even analysts running out of explanations on why their stocks are increasing so much, when we see the rise of penny stocks, when IPOs are hugely oversubscribed, increase in margin lending, excessive valuations, declining credit quality, and many other signs. From an investor's point of view, it is not a bad idea to do some profit booking and to take home some of the exceptional gains you have made in the stock markets. Now, there are many distributors, especially the ones who suggest SIPs, who might not like the sound of profit booking, and we cannot understand why. But to take a page from the SIP book, in our opinion, just like an SIP helps in averaging your purchases, profit booking helps in averaging your withdrawals. Let me say that again. SIPs help average your purchases, while profit booking helps average your withdrawals. Now, yes, there is always the chance, and probably there will always exist cases where you will be letting go of some money on account of opportunity loss. But if the profit booking, when the odds are in your favor, helps you sleep better at night, then why not do it? So when it comes to creating an exit plan for profit booking, you have to be clear about 2 things. Firstly, at what point you would like to play it safe and book profits. For example, in a video on small cap funds that we hosted on the ET Money YouTube channel, we made a case for booking profits only when the relative valuation of the small caps to large caps crosses 1.1x. So that's a scientific and back-tested way of determining at what point of time is it good for you to book profits. The second point one needs to know here is that booking profits is just one part of the puzzle, and you still have to determine how to utilize the profits and where to reinvest the gains. A suggestion here would be for investors to switch over to a different asset class which can be a suitable hedge against an expensive equity market. This is where assets like gold or a short duration debt fund or even a simple fixed deposit will become a suitable pairing, which then has the added advantage of realigning your asset allocation. We all invest our savings as it helps us achieve certain financial goals we have created for ourselves. These can be short-term goals like paying rent or paying for a vacation, or more long-term in nature like purchasing a car, a house, or even retirement. A good reason to exit an investment or stopping an SIP can be the completion or achievement of your financial goal. In fact, for long-term goals, the exit plan starts even before you reach the point where you've completed the targeted goal. In other words, a transfer plan precedes an exit plan for long-term goals wherein one needs to start moving monies from riskier asset classes to safer asset classes prior to reaching your goal. Let's understand this with an example. Say you want to buy a house and over the years you have accumulated about 85% of the apartment's value. Now, the stock markets can take massive swings, and much like a game of snakes and ladders, you don't want to slide down from an 85% achievement to a 60% achievement because of a sudden 30% drop in equities. And for this reason, it is recommended that one should start the process of moving a large part of this 85% to relatively safer instruments such as a short duration debt fund or a bank fixed deposit, which will do a far better job of protecting one's gains than an equity instrument. Now, financial goal based exit plans do offer some flexibility for some kinds of goals, so you'll do well to keep that in mind and manage accordingly. For instance, if the goal is retirement and your asset performance suddenly dips, then you have the option of extending your retirement by an additional 2 to 3 years, and hopefully by then your retirement corpus would have gained ground. However, if this money was needed to pay for something more urgent like your child's foreign university tuition, then you would want to be a little extra careful and match the risk of achieving the goal with the assets where you are invested in. So there is some thinking to be done there with respect to the transfer plan, the asset risk, and the backup plan. But once you've ticked your financial goal, you can peacefully consider exiting from some of the allied investments. Asset allocation and subsequent rebalancing are key elements in any investing plan. The process ensures that you stay within your acceptable risk tolerance limits by ensuring that you move out of overpriced asset classes and move into underpriced ones. A standard portfolio mix that is put forward by many financial planners is the 60-40 mix, with 60% going into equities and 40% to bonds. Now let's assume equities did well last year and grew by 30%, while bonds had a relatively tired growth of just 5%. In this case, your new equity bond ratio will be 78 is to 42, which on a base of 100 would mean a ratio of 65-35. Which means to bring the portfolio back to 60-40, one will have to sell an equity portion of 5% and simultaneously buy 5% in debt. This is basically what rebalancing is, and in our scenario requires exiting some of your debt portions and buying up a little bit of your equity to maintain the balance. A good exit plan here would require you to be ready with which equity portions, that is, which mutual funds or which stocks one will be exiting from. This is pretty important because good investors follow an asset allocation within equity itself and are careful about how much of their equity assets are in large cap, mid cap, and small caps. For example, presently the aggregate of ET Money users have around 60 to 65% in large caps, about 22% in mid caps, and the rest 13 to 14% in small caps. If you're not sure how your equity assets are shaping up, then don't forget to upload your portfolio to the ET Money app and have a check on your aggregate portfolio. Further, when it comes to rebalancing, it is also important to follow a scheduling criteria. For instance, one may choose to rebalance the invest portfolio at a periodic interval like 6 months or 12 months, but then one may also consider setting certain triggers like a 7% or 10% variation, which would then kick in a rebalancing. Remember, a strong asset rebalancing strategy is one of the most essential things you need to do to build a solid portfolio, and exiting some of your investments to maintain that balance is always welcome. The final scenario which can be considered to exit your mutual funds or cancelling your SIPs are to do with the schemes itself. A very obvious one is in the case of schemes which are not performing well consistently over many quarters. In such a case, exiting that fund and moving to a more consistent scheme comes as a natural choice. In fact, if you recall our video on India's best mutual funds, we had identified 11 schemes there that had never been in the top 25 performers in any of the previous 10 years. So yes, these funds were consistently laggards, and it made mighty sense to exit them and replace them with something more consistent and a better performing fund. Another reason for exiting a scheme can be a change in the scheme's fundamental attributes. For example, in 2018, the SEBI came up with a scheme categorization circular which required a number of funds to make wholesale changes to their scheme construct, investing style, and the portfolio. These were material changes to the scheme's attributes which can upset an investor's carefully crafted asset allocation. Having said this, such scenarios do make a strong case for exiting existing mutual funds which do not serve your purpose. And when you do plan to exit, one should consider the impact of the exit load and taxes while redeeming your units. And with this, we come to the end of this video. I sure hope this video has given you some perspective on when one should consider exiting your mutual fund investments and SIPs. If you like this presentation, then do subscribe to the ET Money YouTube channel and help us spread the good word by sharing this video over WhatsApp and Facebook with your friends and connections. Thank you for your time, and we look forward to catching up with you next week with another insightful video. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.